Thank you. Just 1 minute. It's great to have you all here in our house here. Let me start recapping a few messages that Hein brought to life during his presentation. We are in a very early stages of a profound change in Unilever, and it encompasses significant areas of the organization, our culture, our ways of doing marketing, and many, many more things more. We know it's early stages. This is a marathon. It's not a sprint, but we believe that we are making progress. This change is being driven by a leadership team at board level and at executive level that has been significantly refreshed, renewed. There are 3 key strategic thrusts that are part of our growth action plan. We will focus in the areas of business in which we believe we will get disproportionate returns. Our top 70 brands, our top 24 markets. We will excel in 5 demand creation drivers that will make our brands superior, differentiated for the long run. And we will accelerate critical capabilities that will allow us to stay ahead in a very fast-changing world. In the next half an hour or so, I will try to cover a few topics. The first one is how we are making Unilever a simpler, more focused, more productive, more efficient company. The progress that we are doing in 2 fundamental transformation projects, the ice cream separation and what we call our productivity program with the aim of delivering 800 million savings. And finally, try to give you confidence about our ability to put Unilever in a consistent path of 2+% volume growth, plus consistent gross margin expansion that can lead to profit growth in hard currency in line with the best in class in the sector, the ones that has consistently featured in top third total shareholder return. Within my presentation, the President of Foods, Heiko Schipper, will show you how we will run our food business. We consider foods an advantage food business, and it will be a key contributor to our value creation algorithm in the years to come. I will not go into details in what we are changing in our organization because Hein has mentioned this. But from the 1st of January of 2025, we will organize ourselves in top 24 markets that will be end-to-end owned by our business groups. In that structure, we will divisionalize our sales force. These top 24 markets are 85% of our revenue, 90% of our profit. The rest of Unilever, the more than 100 markets in which we operate, in addition to these 24 markets, are markets of low scale in general, and will be run under what we call a One Unilever model, in which we will use the scale of the enterprise, we will reduce complexity to a minimum, and we will try to structurally improve what has been dilutive margins historically. Let me now comment on ice cream separation. It's a huge process. It's a huge program. We are on track in all the metrics, and we will deliver this by the end of 2025. Ice cream is a great business, but it was very clear in our portfolio. And the decision of separating ice cream is fundamentally motivated for the goal of having a very coherent portfolio strategy that leverages innovation, marketing, go-to-market capabilities across what are very complementary business operating models. We are on track, and I will give some color of the progress that we are doing there. Finally, on March 19, when we announced the separation of ice cream, we announced also the launch of a very comprehensive productivity program. It's a change of a magnitude that Unilever has never done before. 17% of reduction of our white-collar workforce, 7,500 people, 800 million savings. We have learned from previous experiences, like the disposals of spreads or tea, in which we didn't attack a stranded cost with the decisiveness we should. And that problem catch up with us, catch up in our margin, and with that, in the ability to support properly our brands. Let me now go a bit deeper in ice cream. Ice cream is a great business in a great category. It will compete in a market that we define as a snack and refreshment that consistently has been growing at 4% in hard currency. We have global leading positions, number 1 or number 2 positions in the top 10 markets of ice cream. We have a focused portfolio with 4 key brands that represent 84% of our turnover. We don't depend on licensing agreements. And we have a superior distribution in the profitable out-of-home channels with circa 3 million cabinets. But it's true that ice cream has very limited complementarity with the rest of the Unilever portfolio. And we believe that under a different ownership structure, this business can thrive because we will set up a financial model, we will set up a tailor-made strategy to really give response of what are very, very distinct features of the ice cream category. This is a category of high capital intensity, significant seasonality, in which fixed cost absorption is key. This is a category that is urban-centric. There is not a lot of benefit of our rural presence in India or in Brazil when you run an ice cream business. Urban centricity maximizes the efficiency of your cold chain. And we will define a model for ice cream that will take into account that. This is a category in which there are a significant amount of new fast-growing channels that will increase the frequency of consumption, that will increase the consumption opportunities. Think about quick commerce, for example. And this is a category in which you have an intrinsically expensive cold chain that you have to optimize. We joke with Peter, we always said that ice cream requires the marketing of beauty and the operational grief of soft drinks. And we will set up an ice cream company to deliver on both. It's true that the business has historically underperformed. When you look at the 2019-2023 performance, you can look at underlying sales growth, volume growth, or underlying operating margin, and it has delivered below the sector, and it has delivered below what is the Unilever group performance. But we are starting to see green shoots. Peter and his team are really making significant operational improvements to the business. On top of that, we are stepping up the investment in our brands. We are launching very, very good innovation, like Magnum Bonbons. There is no Ozempic that can stop that one, I can promise you. It's just, I have become addictive, you know. We are gaining distribution. We are having a rigor in our pricing and promotional management that is completely different to the one we used to have in the past. And the results are starting to show. We are improving our share in a significant way, particularly in markets like the US. Our 9 months performance now shows positive volume growth, close to 4% underlying sales growth, and we expect to close the year with positive UVG and with a significant underlying operating margin expansion. While Peter is improving the performance of the business, Peter and many of us are taking care of what is a very, very difficult separation process. We don't underestimate the complexity of this. We are establishing legal entities and tax models in more than 80 countries. We are setting up transitional service agreements to ensure the resilience of this business, during the operational resilience of the business during the separation process. We are designing a standalone operating model that should be ready to be executed in the market from July 1st next year. We are doing the financial carve-outs, you know, preparing all our financial position and our prospectus. So it's a lot of work. I want to give a bit of color about some of the milestones that we will have. We will give you more color in the mode of separation during Q1 2025. On 1st of July 2025, the business will be a standalone organization that will be operating in their own. We expect to report ice cream as a discontinued operation from Q4 2025. And we expect to complete the full separation of the business by the end of 2025. I know you all read a lot of press also. Recently, there were some news, pseudo-news, okay, saying that we were shelving some supposed plans. You don't shelve plans that never existed. We have been very clear. We said it consistently. Our default mode of separation is a demerge. And it is that because it's the mode of separation that we believe will deliver maximum shareholder value creation and more execution certainty. I want also to take this opportunity to make an announcement of some significant additions to our leadership teams in ice cream. From December the 1st, we will have Abhijit Bhattacharya as the CFO of the ice cream business. Abhijit, many of you know, has been the Philips CFO since 2015 until recently. He has an incredible amount of experience. You know, he has led carve-outs of the Philips lighting and health businesses, very, very successful CFO, and it's a real pleasure to have him with ourselves. And we have also already working with us, Ronald Schellekens. He joined in August. He's our new Chief People Officer for our ice cream business. He has been the Chief People Officer for super successful companies like Vodafone and a snack company like PepsiCo, more than over 30 years of HR experience. And I believe the fact that we have been able to recruit this kind of high caliber leaders is testament to the potential that this business has. So we are very, very happy to have them with us now. After the separation of ice cream, the Unilever portfolio will have very clearly defined profiles for each of our business groups. And we are absolutely convinced that each of these business groups, you know, with different composition, can deliver a combination of top-line growth and profit growth within our long-term guidance range. You will see some of them on the top of the range when it comes to top line, some of them in the bottom of the range when it comes to top line, but we believe each of these businesses can deliver in that kind of range. Beauty and Wellbeing and Personal Care will represent 51% of our revenue, and we expect the contribution of these two businesses to continue growing in the years to come. In Beauty and Wellbeing, the priority is to continue investing, to ensure that we have an industry-beating top-line growth. Personal Care is our most profitable business, and keep growing at a fast rate. Our Personal Care business is a key driver of our value algorithm. We have an incredible position of leadership in home care in emerging markets, but we know that should provide us superior volume growth. But we know also that we have a structural margin issue in laundry and in home care in general that has to be addressed. And we are seeing already in the first 6 months this year, close to 20% increase in our profit growth in home care. In foods, we believe that we have an advantage food business that should deliver more growth and more bottom line margin than the average of the food industry. It's a business that is margin accretive to Unilever and that has a very, very strong cash generation for the business group, and it's a key contributor for the business going forward. Let me give, of course, we are working in the financial carve-outs of ice cream, but we believe that this is a good opportunity to give you some color in some of the impact in our P&L and in some of our key return metrics of the separation of ice cream for the Unilever group. We will have around 20 basis points of volume growth expansion due to the mathematical effect if we look at the last 4 or 5 years of performance between ice cream and the rest of Unilever. But we will have a significant change in margin, gross margin, 130 basis points, operating margin, 90 basis points, and ROIC, a super important metric for us, one of the key metrics of our long-term incentive plans, you know, that will have another 90 basis points of expansion. Probably the question I have received the most since we announced the separation of ice cream is, what will you do with foods? And I want to be very clear, this is a key integral part of our strategy going forward. Foods, Unilever Foods, is a business with a strong foundation and with very strong economics. We have leadership in 3 core verticals. We have 2 brands that represent 60% of the revenue. And differently to what is classic in foods, these are brands with global presence. Knorr is number 2 brand in Unilever by size. Hellmann's is number 5. And foods is a complementary business, synergistic with Unilever in route to market, in business infrastructure, and in many of the capabilities that we are building going forward. The strong economics are very clear. It's one of the top 10 foods companies in the world with more than 13 billion turnover. It has delivered growth and margin ahead of peers. It has margin accreted to Unilever and has a very strong cash generation with a very low capital intensity. We will further simplify our food business. We believe there is around 1 billion, a bit more than 1 billion, of foods revenue, particularly in non-strategic categories, particularly in Europe, local brands that we will dispose in the probably next 12 to 24 months. It will not be a fire sale process. We will dispose this business in a value-protecting way. It will not be a single process. It will be several processes, but we are working on it, and we believe that this further pruning of the portfolio will make our food business and our European business even better. But hey, I'm not an expert in food, so I believe that it's much better to listen from Heiko Schipper, our president of foods, how he will run what it is a very advantaged food business. Video, please.
Delicious. I'm going to have that in a moment. Hi, everyone. I'm Heiko Schipper. I joined Unilever as the president of the Nutrition Business Group in May. I'm delighted to be working in foods and fast-moving consumer goods again. This is where my passion lies. Today, I will bring to life our new business group strategy and how our focused portfolio will contribute to value creation for Unilever. Let me start by giving you a quick overview of our business. We are a 13+ billion euro business representing 22% of the group's turnover and 25% of the underlying profit. These economics are compelling. Underlying operating margin is accretive to Unilever and ahead of most peers. We contributed also disproportionately to Unilever's free cash flow. And underlying return on assets is the second highest of all business groups. Geographically, 54% of our business is in emerging markets, with India, China, Mexico, and Brazil being the largest. Since my arrival in May, I've identified opportunities to strengthen this business and take it forward.
From now on, we will call our business group Unilever Foods,
which better represents what we produce and sell, and it shows the strategic transition we will embark on. Unilever Foods will become a more focused, simplified foods business, playing in faster-growing product segments compared to being a general foods business. Our ambition is to deliver consistent top-tier performance in our peer set. So what does a focused foods business look like? We will rigorously focus on 3 attractive global verticals: condiments, cooking aids and mini meals, and Unilever Food Solutions. This is where we have proven capabilities to win, anchored in our power brands. We will also capitalize on our leading position in India and accelerate the Hindustan Unilever Foods business. I'm convinced that simplifying where we play allows us to execute with precision and generate greater impact. We will double down on consistent, unmissable brand superiority and multi-year innovations, such as the rollout of our Hellmann's flavored mayonnaise range and the expansion of premium Knorr mini meals. Knorr is a 5 billion euro brand, with Hellmann's at 3 billion. Together, they contribute to more than 60% of our turnover. They are complemented by iconic local brands such as Brook Bond in India, Bango in Indonesia, and Lady's Choice in the Philippines. Unilever Food Solutions, which serves professional kitchens, is a gem and a strong customer-facing brand on its own. We have a good track record in this fast-growing food service channel. In the last 5 years, UFS grew mid-single digit per annum and is on track to cross 3 billion euros in turnover. We will widen the geographical scope to fuel future growth. Focus means prioritizing resources. Focus also means exiting some brands and segments that are less complementary to the prioritized verticals through portfolio pruning in excess of 1 billion euros of turnover. Let's now dive into 2 verticals. In condiments, we will make Hellmann's a truly global brand by expanding coverage of the brand, like in India, where we are building the mayonnaise category from scratch and strengthening priority markets with innovation. We will grow through premiumization, such as scaling the squeeze format and flavored mayonnaise range. Our premium-priced flavored mayonnaise almost doubled this year and is on track to become a 100 million euro range. This is underpinned by superiority across all 6 Ps of the unmissable brand superiority framework. Lastly, we've made good progress on Hellmann's market share, now gaining, including in the USA and Brazil, our 2 largest markets. In cooking aids, we will modernize Knorr by innovating on the key consumer need of convenience and the love for trending new flavors and cuisines. Knorr is strengthening global leadership in bouillon through convenience-oriented products and its social-first top dish ecosystem that inspires and enables home cooks. It accounts for more than half of Knorr's turnover and enjoys a significant gross margin advantage. It is growing high single digits and gaining market share. Knorr Mini Meals makes preparing favorite meals and trending cuisines easy in ready-to-heat premium pots, which is highly relevant for younger households. Knorr Mini Meals grew double-digit over the past 5 years, with still lots of opportunities ahead. Now, in short, I am absolutely determined to take foods to the next level. We will reshape the portfolio to focus on 3 resiliently growing verticals and India Foods, where we have proven capabilities to win. Our growth will be anchored in our power brands, Knorr and Hellmann's, as well as Unilever Food Solutions. Future value creation will come when exposure to growth categories in developed and emerging markets meets the attractive economics of our business. Well, remember, I'm a foods guy, so here comes my favorite part. A delicious Hellmann's salad. Hey, get your own.
Cool. Well, you know, I'm from Argentina. I have never tried the salad, but I have tried Hellmann's in beef, burger, sausages. It's spectacular. You know, so, hey, we are not working only in portfolio improvements. We are fundamentally attacking what has been historic root causes of inefficiencies in the company. In the last few years, you know, particularly after COVID, our cost base expanded too much, you know. There are many reasons for that. You know, it was a time in which the global supply chain was very, very constrained. Priority was really in ensuring the resilience of the business. But it's very clear that the cost base went too far. And this was not addressed also when we moved from a geographically led organization to a category-led organization. We have significant geographical complexity. You know, I mentioned before that the top 24 markets of Unilever make 85% of the revenue, 90% of the profit. What I didn't say is that when you look at one Unilever, 15% of the markets, 15% of the revenue, the top 30 markets make another 80% of that block. So in 54 markets, Unilever has 97% of the profit and all, 97% of the revenue and all its profit. So the other 100 markets in which we operate is a lot of effort for not significant returns. Does this mean that we will abandon these places? No. But this means that we will manage in a completely different way, with simplified processes, with models that in some cases will not require legal entities, and we will do it fast. We have 22 transactional process, that we have identified in the company and that have been progressively moved into what we call operational hubs, usually offshore, usually outsourced. But the truth is that the geographical coverage that we have in the operational hubs for this 22 process is very limited. And that's the result of a company that has been historically led on a geographical basis. I have said no many times when I was running Brazil to move staff out. That will not happen anymore. We will do it, and we will do it for the whole organization. Finally, there is an important issue for a company like Unilever that has to drive profit growth in hard currency with a significant exposure to emerging markets. We have around 10 percentage points of misalignment between the fraction of revenue we have in hard currency and the amount of cost that we have in hard currency. And this needs to be addressed. And the operational hubs play a significant role in addressing this issue. We are creating a leaner, more accountable organization in Unilever. The change that we are finishing, that we will implement in 1st of January, with the business groups being fully accountable end-to-end for the top 24 markets, from product development to sales. The sales divisionalization was the missing element in our move from a geographical-led company into a category-led company. That basically gives control to the business group presidents of every demand driver and every line of cost and investment. We are dramatically simplifying processes, and we are aligning the complexity of the process with the risk profile of our geographies. I tend to joke that we run exactly the same process in Serbia and UK, in Honduras and US. That will change. The segmentation between the top 24 markets and one Unilever market is a key enabler to have segmentation of our process and dramatic simplification and removal of duplication. We will more than offset the operational dyssynergies that are generated by the separation of ice cream. These 800 million savings fully mitigate those costs, but give us also additional flexibility to fuel the growth of our brands with more investment. We will reduce the fixed cost base in the company with these changes, and this is very, very important to have additional flexibility. There are 3 principles that guide our productivity program: geographical simplification, organizational simplification, and technology transformation. I will not comment anymore in geographical segmentation, but I believe it's very, very important to understand that since we have put in place the category-led organization, the fragmentation of our efforts has been reduced significantly. We have a much more coherent category strategy, much more coherent innovation programs. And we have now a setup that allows trade-offs within a category across geography. And that usually ends in a much more coherent portfolio than when you make trade-offs within a geography across categories. In organization simplification, in this 7,500 reduction of FTEs, 17% of our white-collar workforce, we are reducing the amount of managers at 2 times the rate which we are reducing the base of the organization. This implies less layers, more span of control. There is more that needs to be done in terms of organizational design, but it's a significant step. And as I mentioned, we are moving more transactional activities into offshore outsourced hubs in which we believe we will not have only labor arbitrage, but fundamentally, we will have a standardized process that will make the company much simpler. The geographical segmentation is also a fundamental enabler for our future technology transformation. We believe that technology in the next 5 years will have probably the change that we have seen in the last 25 years. And when you have to implement these kind of changes in 180 countries, the situation is very complex. So the fact that we are having now a structure of 24 top markets, probably 55 markets that will represent the core of our business, it will allow us to invest more in technology and to ensure that the implementation is flawless. The program is progressing at pace. We are working with BCG. They are providing us a very valuable support. And they have told us that what we have done between March 19, when we announced the launch of our productivity program, and July, when we initiated the consultation process with the European Works Council, usually takes 12 months in many companies. We have taken some risks, but we are making significant progress, and we can confirm now that from the 1st of January 2025, the new organization will be put in place. We are also making progress in the reduction of FTEs. Already we have reduced 1/3 of the 7,500 that we have as target. That implies that there will be a restructuring front loading, but we will have the savings also coming faster. Let me now move into long-term value creation. Let me give you a glimpse of what has happened in the last decade. We have analyzed what has happened with Unilever in the last decade, and we define it as a vicious circle in which anemic volume growth, gross margin decline leading to uncompetitive levels of brand investment, resulted in a stagnation of profit in hard currency. This has been the issues. Our average volume growth, what we call underlying volume growth, was 0.9%. The best in the sector was 2.3%. No surprise, that number is 80% of the real global GDP. We know what it takes to deliver top 30 TSR in terms of the contribution of the top line. In a normalized economy of 3% real GDP, 3% global inflation, that's what we have seen in the last 10 years, and this is what we believe will happen in the future. You need around 80% of the nominal GDP increase at underlying sales growth, and you need 80% at least of real GDP growth in volume terms. We have not delivered that, and I believe this is a shame because we have superior volume growth potential given our category footprint and our geographical footprint, and we are addressing this. Our margin collapsed post-COVID. As I mentioned, there was a serious issue in the global supply chain. We invested a lot in generating extra capacity. At that kind of moment and with the level of change in the market, we made serious mistakes in terms of the innovation we supported. We were too fragmented in our innovation, and we had to invest CapEx to support this kind of fragmented innovation process. And as a result, we didn't cover the whole cost increase with our pricing. And as a result of that, we have a collapse of around 400 basis points of gross margin. As a result of that, our level of investment went down from levels in 2014, 2015 of around 15% to 13%, despite the fact that our portfolio was rotating into categories that are more demanding in terms of media investment. And no surprise, our profit stagnated, no profit growth or negligible profit growth between 2017 and 2023, between 9.5 billion, 9.9 billion delivery, and with no profit growth, no earning per share growth, no dividend growth, no market capitalization increase. So what are the pillars of our value creation plan? Our goal is very, very simple. Deliver absolute profit growth in hard currency that is in line with the companies that consistently feature in the top third of the peer group when it comes to total shareholder return. There are two fundamental backbones for that. Mid-single digit growth with at least 2% contribution from volume. We believe that the contribution volume price should be in a range of 40-60, 60-40, in that kind of a space, in the long term guidance range that we have talked about it. If we deliver that, and we deliver modest margin improvement, anchored in a consistent expansion of our gross margin, we will be able to deliver top third shareholder return. Let me go a bit deeper in these two things. How we will do it? We believe that our exposure to D&E markets, to emerging markets, give us a superior platform for volume growth. We have close to 60% of our business, of our revenue, in emerging markets. Of the total of emerging markets, there are 8 markets that contribute 2/3 to that 60%. India, South Africa, Indonesia, Brazil, Mexico, Vietnam, Indonesia, and China. And for each of them, we have very, very clear roles. We will commit, we will have an unblinking commitment to undisputed leadership in India. Our Indian business is close to 7 billion. It's one of the real jewels of Unilever. The GDP per capita in India today is at the level that Philippines was in 2008 when I have the, I would say, fortune of leading the Philippines business. Between 2008 and today, our Philippines business added 9 euros per capita of revenue, different 9 euros to the one that Hein showed. That was the market growth in the laundry category. But our business in Philippines moved from 450 million to 1.4 billion in 15 years. Imagine 9 euros per capita in 1.5 billion population in India. No need to imagine 9, imagine 5. I'm absolutely convinced that India will be for Unilever in the next 10 years what China has been for some of our competitors in the last 10 or 15. And we know that investors will not reward us for 20, 30, or 40 basis points more of margin in India. We will invest whatever it takes to defend and expand our leadership position in India. South Africa, Vietnam, Philippines, Brazil, Mexico. These are some of our most profitable strongholds. We have incredible market positions in all these markets. And these are markets that are attracting a disproportionate amount of our resources. There are good economic conditions in all of them. Consumers continue changing their consumption patterns, adopting more categories, and shifting to premium. And we are in an incredible position to get a disproportionate advantage for that. Indonesia is a particular issue. Indonesia has been an outlier. What happens to us in Indonesia didn't happen to us in Vietnam, or in South Africa, or in Argentina, or in Mexico, or in Turkey, or in Thailand, or in many other cases. And we are working very hard to turn around that business. But there are some serious long-standing issues that are related with lack of differentiation of our portfolio against a very strong local competitor that tends to operate with a significant discount on pricing. On top of that, the consumer backlash that we suffered to the geopolitical issues by the end of last year in Middle East, has really affected our business there, promotes some kind of losses of share. And in the attempt to recover some of that share, we have done around 1/4 of that. We recovered 1/4%, 1/4 of the share that we lost. We adopted some pricing and promotional initiatives that generated a lot of price instability in the market. And that needs to be addressed. That's the hygiene we are doing in Indonesia business, and that you saw in our Q3 results. But as Hein said, Indonesia is a 6% GDP growth economy. We have an incredible market position, and we will never abandon that market, and we will correct whatever needs to be corrected. Finally, let me say one word about China. We probably got late into China, And when we got into China, we probably didn't have the assets we have today, like the assets that we have acquired in US in prestige beauty or in wellness. And we tried to really go for an all-in strategy in China. And that resulted in economics that were not really very good for Unilever. We are adopting now a selective growth strategy in China, putting real focus in brands, categories, segments in which we have the channels, in which we have the right to win. And we believe, despite very, very difficult market conditions, we will keep making progress in what is now our 4th largest market. But we are absolutely convinced that volume growth for Unilever cannot only come from emerging markets. After the separation of ice cream, our North American business will be 21% of the revenue. Our European business will be 18% of the revenue. And the situations are different. In North America, we believe, we are very confident that our journey for superior volume growth has started. In the last 7 quarters, we deliver average 2.9% volume growth in North America. In US, not North America, in US. We believe that this is superior volume growth in that market. And I believe it's testament to the profound transformation we have seen in our portfolio. North America has been, is, and will remain our first geography when it comes to capital allocation. And we will do that because North America has a feature that no other market has. It has enough local critical mass to build very big brands. And it's a platform for the rollout of global brands. American brands travel. And Unilever, the second source of complexity for Unilever, is the issue that we don't have many brands with global presence. We are probably the global company with the most limited amount of global brands. And we are really committed to change that. We have been doing that in the last few years through a combination of acquisitions and fundamentally putting on top 2 times that revenue in organic growth. We have built, as Priya showed, a very, very powerful prestige beauty and well-being business that has grown for 15 consecutive quarters at double-digit level. But it's not only that. We have taken very, very decisive actions to prune non-strategic brands or brands in the value segment of our portfolio. Suave, Dollar Shave Club, Elida Beauty, etc. As a result of that, we have a portfolio that we believe has going to be to notice the growth potential that it has. Of the 11 billion we will have in our US business, more than 3 billion in prestige beauty and health and well-being, 1.5 billion in an incredible Hellmann's business, 2 times the size of our closer competitor, 1.5 billion in deodorants, more than 40% share, 1.5 billion in hair care, with 4 brands leading 4 specific segments: styling, texture hair, professional hair in grocery, etc. So we believe that really our journey in US has already started, and we are starting to see consistent results. It's moving. Sorry, I don't know why. Well, let me go in advance. In Europe, the journey is different. You know, Europe is a concentrated retail environment in which Unilever discovered too late that the only relevant profit pools are in the premium segment of the market. And we have not provided to the market the level of premium innovation that we should have. But we have started. This year, I believe, we have deployed in Europe the best innovation program that we have deployed in the last decade. And results are starting to show. Of course, there are low comparators. I get it. But 2.9% volume growth. You know, a significant incremental turnover coming from innovation. Pretty spectacular performance in home care and in personal care. You know, significant improvement in our share position in ice cream. We start to see the benefit of deploying some of the acquired business coming from US into Europe in prestige beauty and health and well-being. Of course, there are more work to do, particularly in foods, in which, as I mentioned before, a further pruning of the portfolio for around 1 billion will be very, very significant to do exactly what we did in US, improving the growth potential of that business. Let me go now into gross margin. You can see, when I remember my first conversation with Hein when he came, he said something like, guys, we need to bring the gross margin back to the pre-COVID levels fast, you know? And we are doing it. MAT gross margin by the end of June this year, you know, we basically came back to those levels. And of course, you know, we will not take credit for what we have not done. We know that of our 420 basis points of margin expansion in the first half, around 200, 250 are industry improvements, you know? the combination of pricing carryover, commodity deflation, etc. But it's true also that we are making serious intervention in our cost of goods sold to improve our gross margin. And this will have continuity. There are fundamentally 5 key drivers that we're using: volume, mix, better procurement, higher capex for margin expansion initiatives, and reduction of complexity. Volume, before getting into this, volume is very, very important. Our gross margin is 45%. But when you look at our marginal contribution and the margin of our next unit of volume, in average, is 55%. And if it comes in some of our most profitable business, it can go to 70%. When we start to operate with 2 or 3% volume growth, the machine starts to work. And the improvement in gross margin is very, very significant. But let me go a bit to the procurement interventions we have made. We are targeting net savings. We are targeting for our 27 billion bill of materials an inflation that should be 1% less than the one of the market. In Unilever now, it is forbidden to talk about gross savings. We only talk about savings that you will see in the P&L. And how are we doing that? We are doing changing fundamentally the way we used to buy. We are bringing game theory at scale because we appreciate the partnership with our suppliers, but we are absolutely committed to bring competitive tension and time frame tension. We are making serious interventions in the value chain of some materials. We didn't in US surfactants, where we were the only player in the liquids category with not at all vertical integration. We are doing in self-formulation plants in many parts of the world. And as Richard showed today, we are starting to do it in perfume, in fragrances. And we will do it, to partner better with our suppliers. They have a lot of capabilities that we appreciate. But we need to improve the way we buy, and we are doing it. We are also targeting a significant reduction in our cost per unit, around 2% per annum, in what we call manufacturing and logistics. And this is fundamentally a byproduct of increasing dramatically the amount of capex we allocate to margin expansion initiatives and reducing dramatically the complexity of items in the organization. I was reviewing with Priya the other day how much we have reduced our items in beauty and well-being since the end of 2021. 37%. 37%. Let me show how our capex has been evolving in terms of allocation. There are fundamentally 4 ways of allocating capex. You do it for capacity, you do it for innovation, you do it for infrastructure, quality, sustainability, safety, or you do it for productivity. And in the last decade, Unilever has allocated very little to margin expansion. We are now committed to improve that level to around 55% or more. And when you do that in our turnover, you are talking around 1 billion euros of capex that you allocate to margin expansion. Consider 3-4 years payback and make your math in what is the impact in gross margin. I have mentioned many areas in which we have to improve. Let me mention only one in which we want to sustain what has been excellent across time. That is cash conversion. And fundamentally, the impact of negative working capital in cash conversion. We are one of the top 5 better companies in the sector when it comes to working capital. And when you have a strong top-line growth and you have a strong negative working capital, the growth rate of your cash grows exponentially. This is a fundamental element that will ensure levels of cash conversion around 100 in the years to come. A bit of color in capital allocation. There are 3 fundamental pillars in which we will allocate capital. We'll allocate capital for growth and productivity to ensure the long-term sustainability of the economics of our business. It is investing in our brands, it is investing in R&D, it is investing in capacity expansion, it is investing in productivity. We will continue allocating capital, around 1.5 billion a year, to optimize our portfolio, to keep rotating our portfolio into more premium segments. We will do it through selective bolt-on M&A, and through the pruning of the portfolio that I have mentioned before. Transformational acquisitions are off the table. Finally, we will deliver capital returns to our shareholders in an attractive level. We want to ensure a 60% payout ratio. We want our dividends to grow in line with the profit growth. And we will not sit in unused cash. If at one moment of time, as it has happened in the last 2 years, there is cash available, we will return it to our shareholders in the shape of buybacks. This not working here. Let me put a few numbers around this. You can see how our BMI is improving. 2022, 13% of the revenue. 2023, 14.3%. First half this year, 15.1%. We expect between 15 and 16% for the full year. CapEx, more than 3%. We are investing for the future. Portfolio rotation. Since 2017 until now, more than 1/3 of our portfolio has rotated. Capital returns, close to 20 billion in 3 years. With a breakdown in the last 2 years, 75-25 dividends buybacks that we like. But we will not force it, but we like it. So let me finish with a summary of our value creation model. We will deliver absolute profit growth in line with the companies that are consistently in the top third of top shareholder return. The backbone of this will be the combination of mid-single-digit growth with a strong contribution from volume at least 2% and modest margin improvement. We will deliver cash conversion at around 100 basis points. We will maintain a leverage level of around 2 times EBITDA when it comes to net debt. This combination of cash conversion, net debt level, that kind of leverage, will ensure that we retain what is a strong single A credit rating with financing costs that will be only a very limited fraction of what we expect to be high teens return on invested capital. We want to cement Unilever in the top third of return of invested capital of the peer group. This is one metric that has exactly the same weight in our long-term incentive plans than the one we give to total shareholder returns. And that shows how important it is for us. Finally, we will allocate capital for growth and productivity, for keep rotating our portfolio, and to ensure that our shareholders have attractive capital returns. I'm finishing, and basically I would like to repeat a couple of things. We are in very early stage of a serious, profound change in Unilever, but we are doing it at pace. We are stepping up our execution, we are accelerating our transformation, and the Growth Action Plan 2030 is anchored in 3 fundamental pillars. Focus in areas of business with disproportionate return. Excel in 5 demand drivers that deliver superior differentiated brand equities, and accelerate critical capabilities to ensure we stay ahead in fast-changing world. Our value creation model will be anchored in a 2+% volume growth. Don't expect from us margin guidance. Expect from us to invest consistently with that ambition. We want to deliver consistent gross margin expansion, and that will be the basis of a modest operating margin expansion, and the combination of all this will deliver absolute profit growth in hard currency in line with our expectations. Finally, we know there is a lot to do. If you ask me, Fernando, what are you guys? Give me a score in a 1 to 10 scale of how good you are. How good is all the stuff that you do? I would probably give me a 6. Give us a 6. My mom used to say that 10 doesn't exist, but from 6 to the 8, 9 that we believe should be our ambition, there is a lot that has to be done. Thank you very much. We go into a very short break, 2 minutes, and after that, Q&A. Thank you.